post-action review of week 1, and let this image be foreshadowing as to what I might have purchased. So I bought RIG and I bought BTU. RIG is Transocean, they do offshore drilling, and BTU is Peabody Energy, coal mines. I bought 3 shares of RIG and 1 share of BTU. So let's jump into the meat of this and discuss my reason, rationale, and touch upon quite a few talking points. What are some risks? Normally, people like to tell you what all the reward and upside is as to why they bought something and the total addressable market of it and rocket ship emojis and why you can make money. But as Warren Buffett said, rule number 1 is don't lose money. So maybe we should talk about the downside. Talk about the downside, the upside takes care of itself. If you get the thesis right and everything else, not to oversimplify it. But what are some risks? So to quote these people, and this does matter, I'm not just saying this as a side note to dog on these people. And of course, as the largest private sector coal company, a company that claims to work to solve energy poverty while clearly showing no regard for low income and marginalized communities, quote, Peabody is responsible for 0.86% of historical carbon dioxide emissions, end quote. Quote, it's now time to unite and escalate our resistance to the world's largest coal company, end quote. Quote, we're calling on Peabody to stop destroying our communities, democracy, and climate, end quote. So there's a lot of common themes across these quotes, and they do matter. So a note on the energy poverty being conflated with low income. It's a intentional conflation of categories. It's this play on homonyms with different definitions, but they sound alike, and it's a play on words in an ambiguous co-opting fashion with an implicit negative connotation that is often represented by the emotional type. And the reason that matters is essentially if someone doesn't mind being dishonest and acts primarily on emotion with loose, grounded, supportive evidence that much of isn't factual in itself or out of context, then if those people are against you, i.e. your company, your investment, then that might be of concern. And of course, those same types of people who are maybe trying to shut a business down are also found in the people who are hyping a business up. So it can work in your favor or against you. So 70% of steel production uses metallurgical coal. That's coking coal. Now that kind of matters because implicit in the statement coal is assumed by many to be thermal coal. But much of coal's usage is in making steel. So stop destroying our communities. But aren't the communities built with steel? And if the answer is yes, then it's either we cannot build any more community that uses steel and or repair steel in our community, such as something as simple as welding rods, let's say, even though I don't know if those are made with coking coal. But so if we're going to keep using steel in our communities, but we're telling you to stop making products that aid in the making of steel, then what that means is not in our backyard. Destroy other communities. And that's not just a double standard hypocritical pointing out. The reason that matters is because it matters. And that's why, even though this presentation is primarily built around Peabody Energy, the other one was RIG, which is an offshore drilling. And that's quite relevant, offshore. Why? Because it's not in your backyard anymore. It's in someone else's backyard, and even better, it's not even necessarily in their backyard. It's out of sight, out of mind. Because you're going to keep on using your oil. You just don't want it to come from nearby, and fair enough. So you export it to be produced somewhere else. Next point, 37% of energy globally uses coal. That kind of matters. Because what you're saying is, depending upon how radical and ideological you are, to say stop the production of coal is to say stop 37% of energy production globally. And I myself actually use coal. My power plant operates off of coal. So that's worth thinking about. And they're not the world's largest coal company. Glencore, Rio Tinto, BHP, Billiton, Anglo American are some of, or were some of the largest coal producers. And, by the way, they're also reducing their exposure to coal. Now, some of the largest world producers are Coal India, I don't know how to pronounce that, Xinhua Group, China Coal. These are the largest coal companies, and not a coincidence that they're in China and India, as we'll get to in a moment. But no one's trying to pick at them. I mean, if you want the biggest bang for the buck and don't want your efforts to be fruitless and in futility, I guess you work where you can and operate where you can and influence what you can. But if what you're trying, you're mislabeling what Peabody is. They're not the world's largest coal company. Hands down, they're just not. Now you could say maybe they're, you could have contextualized it, but as you've noticed already, I'm pointing out a bunch of errors. And this all matters because people are making decisions that are error prone and error filled that affect directly the company I'm invested in. That's why we said risks. And the threat that this sort of illogical thinking and poor articulation cannot be underestimated. Okay, ESG, why does this matter, as we touched upon? From an investor standpoint, as a shareholder standpoint, we're not getting, even though we are, but we're not getting excessively and unnecessarily political here. The point of this is to understand how it in fact affects our investor thesis and what we believe will happen in the present time and future time that will benefit our investment. So, what ESG, environmental, social, and governance, they've deemed coal bad. Even though, as we noted, 37% of global energy uses coal. Like that's 37% of society, which is the social part of ESG, but yet again, that's beside the point. The reason this matters is because access to capital markets, lines of credit, carbon taxation, lending at unfavorable terms, canceling permits, and forcing the shuttering of mine sites can negatively impact this investment. Now, it also helps because it consolidates the industry, which gives people pricing power. So, depending upon how you look at it, it can be a benefit or it can be a cost. So, underinvestment plus demand growth, because demand, by the way, is growing, we'll get to that. Underinvestment coupled with demand growth means there's a supply imbalance, which also means less flexibility to smooth out demand or supply disturbances. That should not be distributions, but disturbances. And we saw this in the past couple of years. When you get supply chain logistical issues, some external exogenous effect happens. That could be a couple of uranium mines back in the early 2000s flooding. And that shoots up the price of coal, because when it's a tight market and there's not a lot of margin for error, every ton matters. And, well, we just saw that recently in a bunch of commodities. What this also does is emphasizes the need to be able to use internally generated cash flows to maintain and build. This implies that the pace of recovery and production growth is limited to cash flow because the access to capital markets are turned off and or the lending terms are unfavorable, so they're not stupid, hopefully, and therefore they're not going to borrow. So they're relying solely on cash flows. And that slows down the recovery process, which only means higher prices for longer. Not only, but one of the things it means is higher prices for longer. What this is, energy return on investment, EROI. Most people don't do well with transition periods. I think the idea of reducing carbon emissions is a good, broad, general idea. But then it comes down to the application. And if I know one thing about people, it's that they don't do things the smartest way. So you really want, you don't want to, as the saying goes, you don't want to quit a job until you have another job lined up. Just like you don't want to undermine your energy infrastructure without having something to go to, instead of just doing without for a while. Like maybe it would be a good idea to have the technology in place, presuming the technology exists, to transfer over to. So the reason all of that matters is because there's other people who want the same quality and standard of living that we have in the Western world, the OECD world, and they're not going to let perfect get in the way of good. The Western world, net neutral, is a mental accounting compartmentalization game in which they export carbon emissions to less environmentally regulated countries that use dirtier fuel sources. Because it's not about, and this is how these things get co-opted and bastardized, is it's not about reducing carbon emissions per se. It's about reducing your carbon emissions. And then there's all kinds of, yet again, accounting ways and compartmentalization ways and gerrymandering and games they play and wording and all of that affects all of this. And so it's counterproductive, but yet again, is this in our benefit as an investor in these companies or not? Well, if you know that they're going to export the production of oil to other countries, then betting in those companies that are going to be in those other countries might aid and benefit you. If you export manufacturing to India or China, which uses more coal and oil and less natural gas and nuclear, it's less efficient, less is getting done for more, both in emissions and productivity. After all, since we're the end user, it needs to then be shipped back to us, and that's even more carbon emissions. So we could produce something with natural gas, or we can make someone else produce something with coal. And if the name of the game is we need to produce less carbon emissions, then one way that can be done is to export it where it's going to be produced with coal instead of natural gas or nuclear. And that puts a demand on coal. What I want to get to in here is the wealth S-curve. I'm only going to touch on it loosely here, my version of loosely, but it's really worth knowing and understanding. Per capita energy consumption grows exponentially once a country gets to about 3,000 GDP per capita. That's crucial to know, and we'll talk about that a few more times by the time it's all said and done. In China, from 2001 to 2008, oil consumption grew from 1.4 barrels per person a year to 2.2 barrels. Vehicle sales went from 2.2 per thousand citizens to 9. So that's a 50% increase in 7 years of barrel per person consumption and a fourfold increase of vehicles. Airline passengers increased from 57 to 100. That's, 45% increase. China's oil demand quadrupled from 0.03 barrels per person to 0.12 barrels per person. Long-term real growth in U.S. GDP per capita. You have to go all the way back. Actually, on this last slide, you'll see that the takeoff point is around 3,000 GDP per capita. Then the turning point is around 10,000 per capita, and then the zero growth point. This is in reference to energy consumption, by the way. And then 20,000 per capita is the zero growth point. So in the United States, we hit the tipping point way back in 1870. around $3,000 of GDP per capita. It took 70 years for us to get to the turning point, which was around 1940. Then it took 30 years for energy use to double to get to the zero growth point around 1970, late 1960s. Okay, if you look at this chart, you'll see that about 1970 is when U.S. primary energy consumption flatlined-ish. It didn't necessarily flatline, but it stopped its exponential function because 1970, as we noted, is when the GDP per capita hit about 20,000. This is not a coincidence. This is absolutely crucial to know and understand. Okay, OECD, Western world, is not the world. Everyone talks about the world. Coal being phased out is a myopic and ignorant statement. Everybody is talking, not everybody, but you know what I mean, hopefully. And many people are talking about how coal is being phased out and there's better fuel sources and this and that, but that doesn't mean that it is being phased out, because it's not. As we'll get, it's being phased out in certain places, and those certain places are the Western world and the solipsistic, egocentric, self-absorbed people of the Western world who seemingly don't actually have a global understanding of things, even though they want to talk about the globe, which really is just them being personally incredulous, which is being confident in their own ignorance, which allows them to say dumb stuff to begin with, which you can record back to when I was talking about the risks initially to coal and all the ignorant things those people said, but yet are confident in saying, which only manifests in their action, which means that they'll go ahead doing what is objectively stupid things because subjectively they feel correct about it. But this isn't a psychology course, so I digress. World's primary energy source over time. Coal is growing. Not only is it not flatlining, it's growing. Crude oil is growing. Pretty much everything is growing. Nuclear, hydro's, it's kind of staying steady. Natural gas, oil, and coal. They're growing, they've been growing, they're going to continue to grow. China. Back in the early 2000s, there was a commodity boom. The general consensus is that commodity boom was caused in large part by China. And the same GDP story we told about the wealth S-curve and its exponential increase that comes along with it in the domain of energy consumption is crucial to know. And it's an underpinning thesis for the investment in my investments. They hit their tipping point around 2005. It took them 12 years. Remember, it took the U.S. from their tipping point to their turning point. It took them 70 years, or it took us 70 years if you're a United States citizen. Listen to this. It took us 70 years. It took China 12 years to get to their turning point. And they're going to hit their they're going to hit the 20,000 mark soon, which means that their energy consumption is now going to kind of flatline or not be exponential at least. And that's coming up in 2025, 2027. But so this could be a risk because soon enough they'll stop consuming as much coal, or the rate of change in which they're increasingly consuming coal will slow down, and the stocks I have are a second or third derivative of that rate of change, and as a consequence will be impacted proportionately so. But we're going to talk about India. But first, look at coal consumption, this big blue bulging bar of coal. That is not coal being phased out, people. And that oil, which is the orange, now some of that coal might get converted to natural gas, and it might get converted to nuclear, and it might get converted to oil, as it probably eventually will. But coal is the cheapest, quickest way to start producing energy. So that's what you do. Yet again, they're not letting perfect get in the way of good. Because what's good is that their people don't die and that they get to the global markets. At least that's what they've considered and deemed good. India. India is just at the beginning of all this, which is often why the Indian markets are always trading at a high multiple, because everybody knows this. And India is just now, in the last few years and upcoming years, is getting to the tipping point. This is only the beginning. Now, what you'll notice in this chart is that their chart is a small representation of the Chinese chart. This chart is going to stay looking the same, except it's going to be an order of magnitude larger in product. And if you think India uses a lot of coal now, you just wait. You think India uses a lot of oil now, you just wait. As the energy consumption grows exponentially, once India starts hitting, or is hitting, or continues to hit their per capita requirement of the tipping point to the turning point, this is going to rocket ship emoji. The Jevons paradox is when technological progress increases the efficiency of a resource used, reducing the amount necessary for any one use. So you would think that, oh, okay, we have new technology, we can use less coal now. But the falling cost increases its demand because now it's cheaper. So people not only keep using it, but then they start using more of it. And that's a crucial thing to know. Just because you're better able to use a product more efficiently doesn't mean that the consumption of that product will diminish proportionately. If anything, it will actually grow, maybe not exponentially, but it will grow because it's cheaper to use now, which means you can use more of it to get more done and then grow. And don't forget, roughly 6 billion people want the same standard of living that we have in the Western world. And they don't plan on stopping. So more risks. Natural gas to coal conversion happens around the $3.50 level. We're actually lower than this from the time I made the chart. I think we actually might be at $4 now. So this is the chart. That's a risk, because that means it's a risk insofar as you're considering places that are able to convert. Yet again, India is not, don't worry about India when it comes to this. They're not converting to natural gas. They're just now getting the coal going. It's a succession, progressive, sequential development. Maybe in 10 years this will be an issue when they have more refineries and liquidations, factories, and all the infrastructure necessary to be able to convert. But they're not there right now. So this is more of an issue when it comes to the Western world. Now, I always say that if you're looking at a chart, this is how you test your bias. If you're looking at a chart, this is the correct chart. If you're looking at this chart, you say, is this a bullish chart or a bearish chart? Is it a reversion to the mean? Is there, technical patterns? Is there a pennant? Whatever, however you want to look at charts. However you deem a chart looking bullish or bearish, you say, is it bullish or bearish? I would actually say that this is bearish for coal consumption in regards to what I said of being converted back to natural gas, because this is a natural gas chart. It's getting cheaper, which means that more conversions are going to come in the future if it maintains its getting cheap. And you can see that these spikes don't last long and then they revert back to the mean. So you flip the chart upside down and then you ask yourself, if you thought the last chart looked bearish, then that means you should think that this chart looks bullish. But if you don't, then that means that you have a bias. And you really need to consider that. Always look at a chart upside down if you're having doubts. Because I would say that this chart looks bullish. Why Peabody? I've been in and out of this trade before. I bought in around 10. I think I sold, I don't know, mid-teens. And then there was a pullback. And then it rocket shipped. And then I bought around 20. And then I think I sold around mid-20s. And then I kind of got out for a solid half a year or something. And then, so I've been in and out of the trade. And of course, like most idiots, I try to trade around the position and then to negate downside risk, and all I do is cap my upside reward, and I've missed the majority of the move because of it, and hopefully lessons learned and lessons that you can learn without having to make them yourself. So I'm somewhat familiar with Peabody. For instance, how any given day you can just move 10% for what seems to be no reason. Even though things don't make sense until you look at it from a point of view in which it does make sense. So there are reasons it's moving, but nonetheless. The other reason I bought Peabody is because when I made my initial video, the precursor to this series, whatever you want to call it, there were a bunch of stocks on my watch list that I wanted to buy at the time because they were cheap enough. But by the time the season came around, January 1st, they all went up. So nothing else was at my buy point. And actually RIG didn't hit my buy point. It wasn't necessarily a FOMO situation. It was more of it was a small position that I can easily average down on. So that's kind of why I did it. Because right tail risk, how much, GameStop taught us that, I would hope. How much can this go up? As well as how much can it go down? And to me, I'm bullish on oil. So I bought a little bit. No regrets. So nothing else was on my watch list that hit my buy point. That's why I bought Peabody. It was kind of lower down, but here we are anyway. So there was the end of year window dressing because people don't want coal stocks having to be reported to their limited partners and investors because it's unflattering and not ESG and blah, blah, blah. And then the beginning of the year rebalancing of people waiting to the beginning of the year to take profits on big trades. And I thought that was going to last a little bit longer, but maybe not. By seeing the rebound that happened the second half of the week. So, Peabody. For me to even say this is a concern and a red flag in itself, but as long as management cannot screw it up. There's a lot of doubt of the competency and alignment that Peabody management has with shareholders. Like entertaining mergers and acquisitions and not immediately stomping out the rumors of it. So hopefully they can knock the debt down like they've been doing. They can stay away from M&As since that's more top cycle behavior or reflective of an ignorant management team or perversely incentivized management team. And the name of the game is to return capital back to the shareholders, whether that be buybacks or whether that be dividends. And they're kind of behind a lot of these other big names. So Peabody was just in worse condition. So as they get to the same level of these other companies, you can kind of use them as a model for what Peabody might do itself. And it's actually, interestingly enough, at its post-bankruptcy issuance price. And I'm assuming, the way I'm justifying this is I'm assuming a lot less risk now than I would have back in 2017 because it went from $26 down to $1.50 and here we are back to $26, $27. Cash on balance sheet is growing. Once it gets too big, it might become a takeover target, so they need to do something with the capital. Hopefully that's accretive to the shareholders. Free cash flow is growing. They're a quarter or two away from capital returns, at least that's the general consensus out on the Twitter web. And yet again, like I just touched upon, one could argue that buying here is a safer bet than when it was in single digits. But with risk comes reward. That's why those who bought at the lows are up over 2,500% at the $1.50 range. I think it hit $1.50 numbers. And now it's up 2,500%. So, but maybe I don't, take on less risk, you get less reward. That's just the name of the game. Back to management concerns. As someone said, and I'll quote, "I've never seen so many investors so schizophrenic over a security. Option abuse is likely a culprit for this inane, frantic trading. Any other deep cyclical reporting so much cash printed would see jubilation, not deranged paranoid gibberish." And there is quite a bit of that. And one of the things I've seen is people thinking that on an earnings call, this was back during the M&A issues of summer, earning call stuttering and non-answering during an earnings call was interpreted by a couple of people as the CEO and the board of having some kind of a letter of intent with a penalty clause, so they really couldn't touch or talk about anything. That's kind of, that might be true, but that's the kind of paranoid that we're talking about in the above quote. M&A is top cycle behavior. The latest gossip has been put to rest. M&A often leads to huge impairments and goodwill markdowns, and synergies, when they do work, take years to play out. You'd think that Peabody would have learned from their $5.2 billion acquisition of MacArthur Coal that led them drowning in debt-laden burden and access to capital markets evaporating, which is what put them into bankruptcy, which is what got them out of which led to them coming out of bankruptcy in 2017. And now me, in beginning of 2023, buying in at that price that it listed for in 2017. And that's it. I know I didn't touch upon RIG much. Might do that in the future. This went longer than I wanted, which I knew it would, which is why I didn't touch upon it much.